This next question comes from Advait Prasad in New York. He writes, today, Berkshire holds over $300 billion in cash and short-term investments, representing about 27% of total assets, a historically high figure compared to the 13% average over the last 25 years. This has also led Berkshire to effectively own nearly 5% of the entire U.S. Treasury market. Beyond the need for liquidity to meet insurance obligations, is the decision to raise cash primarily a de-risking strategy in response to high market valuations, or is it also a deliberate effort to position Berkshire's balance sheet for a smoother leadership transition, providing Greg Abel with maximum flexibility and a clean slate for future capital allocation decisions? And I will add one line from another shareholder, Mike Conway, who asks, are you encouraged you may see some fat pitches coming your way?
Yeah. Well, I wouldn't do anything nearly so noble as to withhold investing myself just so that Greg could look good later on. Now, if he gets any edge when I leave, I'll resent it. So the amount of cash we have, we would spend. Well, we came pretty close to spending $10 billion not that long ago, for example. But we'd spend $100 billion. I mean, and those decisions are not tough to make. When something is offered that makes sense to us and that we understand and offers good value and where we don't worry about losing. And the one problem with the investment business is that things don't come along in an orderly fashion, and they never will. I mean, it isn't like every day. The long-term record is sensational, but that is not a product. And I've had 200 trading days times 80 years. I mean, 16,000 trading days. It would be nice if every day you got 4 opportunities or something like that, and and they were expected to be equally attractive. If I was running a numbers racket, every day would have the same expectancy of that I would keep 40% of whatever the handle was, and so the only question would be is how much we transacted. But we're not running that kind of a business, and so we're running a business which is very, very, very opportunistic. And Charlie always thought I did too many things. He thought if we did about 5 things in our lifetime, we'd end up doing better than if we did 50, and that we never concentrated enough. So that we would rather have, if we've got $335 billion now in treasuries, we would rather have conditions that are developed where we would have like $50 billion or something like that. But that just isn't the way the business works. And we have made a lot of money by not wanting to be fully invested at all times. And we don't think it's improper, actually, for people who are passive investors just to make a few simple investments and sit for their life. But we've made the decision to be in the business, so we think we can do a little better than that by behaving in a very irregular manner. But if you told me that I had to invest, let's say that we have a roughly $40 billion a year coming in, and we start with 335. If you told me I had to invest $50 billion every year till we got down to $50 billion, that would be the dumbest thing in the world to invest in that manner. Things get extraordinarily attractive very occasionally. The long-term trend is up. Nobody knows. And I certainly don't know. Greg doesn't know. Ajit doesn't know. Nobody knows what the market is going to do tomorrow, next week, next month, and nobody knows what business is going to do tomorrow, next week, or next month. But they spend all their time talking about it because it's easy to talk about, but it has no value. I've never found anybody I wanted to listen to on the subject. And on the other hand, I've found that leafing through things like that big Japanese book that I can't read anymore, that's a treasure hunt. And every now and then you find something, and occasionally, very occasionally, but it'll happen again, that I don't know when. It could be next week, it could be 5 years off, but it won't be 50 years off. We will be bombarded with offerings that we'll be glad we have the cash for. And it'd be a lot more fun if it would happen tomorrow, but it's very unlikely to happen tomorrow. Very, very unlikely to happen tomorrow. But it's not unlikely to happen in 5 years. And then the probabilities get higher as you go along. It's kind of like death. I mean, if you're 10 years old, the chances that you're going to die the next day are low. If you get to be 115 or something like that, it's almost a cinch. Particularly if you're a male. I mean, all the records are held by females in terms of age. And I tried to get Charlie to have a sex change so he could test out whether... he did pretty well for being a male, I'll put it that way.
Wow, did you hear what he just said there? $300 billion in cash. 300 billion. That number alone is enough to make your head spin, Alex.
It truly is, Sarah. And it's not just a big number. It's a strategic number. It tells us so much about Warren Buffett's mindset, even if we're not operating with billions.
Exactly. And that's the whole point of 1% mindset, right? How do we, the everyday hustlers, the people grinding to build their first $1,000 or even just get out of debt, take lessons from the Oracle of Omaha? Because let's be real, most of our listeners aren't sitting on a pile of cash. They're probably wondering where their next opportunity is coming from. Just a quick reminder, guys, this is not financial advice. We're just sharing ideas for education and entertainment.
100%, Sarah. So Buffett holding this colossal cash pile at Berkshire Hathaway isn't about being lazy or missing opportunities. It's the opposite. It's about extreme patience, discipline, and being ready for the right opportunity. He's not buying just to buy. He's waiting for elephants, as he calls them, massive, undervalued companies that fit his specific criteria.
Okay, so elephant hunting for a billionaire. How does that translate for someone who's, squirrel hunting for their first side hustle or trying to save their first $100? Because it feels like if you have zero capital, waiting for anything feels like a luxury.
That's a brilliant reframe, Sarah. For someone with little to no capital, your cash isn't just money. It's your time, your energy, your skills, and your focus. Buffett's patience isn't about inaction. It's about focused action. He's not just letting money sit idly. He's actively searching and preparing. For you, it means not jumping on every single make money fast scheme or spending your precious free time on low-value activities.
So instead of throwing your energy at 5 different side hustles that might fizzle out, you focus on mastering one high-income skill or really researching that one business idea that aligns with your passion and market need. That's your elephant.
Precisely. You're building your cash pile in terms of expertise and understanding. Buffett also talks about the market being overvalued, meaning good deals are scarce. For the everyday hustler, this means not blindly following trends or investing in things just because everyone else is. It means being critical. Is that online course truly worth your limited funds and time? Is that new gadget going to genuinely help your productivity or just be another distraction?
That's a huge one. It's so easy to get FOMO, fear of missing out, especially when you see others crushing it. But what I'm hearing is Buffett's FOMO is actually not buying something just because everyone else is.
Exactly. He's saying, I'd rather miss a few good deals than make one bad one. For us, that translates to extreme caution with our limited resources. Every dollar, every hour counts exponentially more when you're starting from scratch. That leads us to another key reason for Buffett's cash pile: safety and optionality. He holds that cash as a cushion for downturns and to be able to seize opportunities when others can't.
Okay, Now this is where it gets really actionable for everyone. A cushion, an emergency fund, even if it's just $500. It's not about making money, it's about not losing money or being forced into bad decisions.
100%. Think of that emergency fund as your personal Berkshire Hathaway cash pile. It gives you optionality. It means you don't have to take a terrible job because rent is due. It means you can afford that small course to upskill when a new opportunity arises. It means you have the peace of mind to focus on building something long-term instead of constantly putting out fires.
That optionality is so powerful. It's like financial breathing room. And then, when others are panicking, Buffett is ready to buy when there's blood in the streets. How does that apply to us?
Well, when others are pulling back, when the economy feels uncertain, that's often when opportunities emerge for those who are prepared. If you've been patiently building skills, saving a small emergency fund, and researching your elephant, a downturn might actually open doors. Maybe a local business needs a specific service you've been honing. Maybe a competitor folds, creating space for your side hustle. It's not about celebrating others' misfortunes, but about being strategically prepared to step up when others retreat.
So it's about being the person who's been quietly sharpening their axe while everyone else was complaining about the dull blades.
You got it. It's about seeing crisis as an opportunity for those who have conserved their resources, whether that's cash, time, or mental energy, and are ready to deploy them thoughtfully.
This is so good. If you're a true hustler looking to grow your wealth, make sure you hit that subscribe button right now. We're constantly breaking down these big concepts into everyday, actionable steps for you.
The core principle here, whether you have billions or barely anything, is discipline. Buffett's cash isn't just sitting there. It's a testament to his discipline in not investing until the conditions are perfect. For us, that means disciplined saving, disciplined learning, and disciplined action.
So, for our listeners, the actionable takeaways from Buffett's cash pile are first, be patient and disciplined. Don't chase every shiny object. Focus your limited resources on your elephant, that one high-value skill or opportunity. Second, build your cash pile, even if it's small. That emergency fund gives you optionality and prevents you from making rash decisions. And third, be prepared. When others retreat, be ready to step up and seize opportunities armed with your skills and your small but mighty cash cushion.
Exactly. It's about playing the long game, even when you're just starting out. It's the 1% mindset in action.
What an incredible breakdown, Alex. I love how we can take a billionaire strategy and turn it into something so practical for everyone. Thank you.
My pleasure, Sarah. Always great to connect these dots.
And thank you for tuning in to the 1% Mindset podcast. We hope this episode sparks some big ideas for your financial journey. If you found value in today's discussion, please hit that like button, subscribe so you don't miss our next deep dive, and share this episode with a friend who needs to hear it. Until next time, keep that 1% mindset strong.